The FTSE 100 beat the S&P 500 over the course of the last 12 months, returning 21%. Gold returned 63% over the course of the last 12 months, and silver returned nearly 180% over the course of the last 12 months. And it could be why long-term investors are about to make a big error. This is around something called recency bias, which is hardwired into us as humans, and it makes us think that because something has happened over the course of the recent past, last 12 months, that it is going to continue in the same vein. That isn't necessarily always the case. I'm getting a lot of comments from people saying that they're piling into precious metals as a result of the returns over the course of the last 12 months. Now, those returns that I mentioned are completely anomalous. We haven't seen returns like that in precious metals for decades. Now, I'm not saying that next year we're not going to see great returns in precious metals. I don't know what they're going to return. I'll be very surprised if we get the same sort of returns as we have over the course of the last 12 months. Look at the FTSE 100, for example, 21% over the course of the last 12 months. However, the average return is 6.9% over the course of the last 10 years. That is inclusive of that 21% gain last year, which has pulled that average up. For a long-term investor, it's great to have exposure to different sorts of asset classes, but it doesn't necessarily mean that because something has gone up recently, it's going to continue to do so, and it is a good investment decision. For me, I keep it incredibly simple. I invest into an all world, which covers every geography, whichever one's going to do well. And I also invest into a few pieces of precious metals myself. So just make sure if you're a long-term investor, you're considering these things. You're not jumping in to products just because they've done really well over the course of the last year.